How is everyone doing? Welcome to the Strategy Room on this Saturday night, September 27th, 2025. I hope everyone is having a great night and a great weekend out there so far. We've got a great show here for you tonight. We got 2 hours of nonstop banking and business news for you. Isn't that wonderful? All right, we are going to start off. I usually like to start off every these episodes with looking at the debt clock, but unfortunately, the debtclock.org website having some issues there today. So we are actually just going to jump right into the news articles. But I will tell you, not much has really changed in the last week. National debt still at $37 trillion. The U.S., the national deficit still a little about 1.9 trillion. So not a whole lot of change there. So not too much to worry about. But what is the big news at the moment here? So we are basically barreling toward this government shutdown here. So we have this government barrels towards shutdown as House funding stopgap bill fails on the floor. So with House GOP in disarray, Senate Majority Leader Chuck Schumer has the opportunity to define the terms of a stopgap funding bill to forestall the shutdown. But I don't know if I see the House, GOP in disarray. What I see is the Democrats coming through with a lot of requests, a lot of things that they want. A lot of things that are completely out in left field that are just never going to happen. But let's see here. So the House of Representatives defeated a stopgap funding bill on Friday, dealing a blow to House Speaker Kevin. Oh, you know what? This is killing me. I got the wrong article here. Okay. All right. Here's what to know about a federal government shutdown. So a looming U.S. government shutdown could leave hundreds of thousands of federal employees without pay and delay key economic reports, including U.S. jobs data. President Donald Trump canceled a scheduled meeting with top Democratic Rep. Hakeem Jeffries and Senator Chuck Schumer. That was to discuss resolving a standoff over a temporary funding measure. Democrats want the stopgap to include health care protections, including extensions of enhanced Affordable Care Act tax credits that are set to expire at the end of the year. So we have this looming government shutdown here. I don't know how this is really going to play out for the Democrats here, and I'll tell you why. So here's the next thing. Trump OMB orders preparation for mass firing of federal workers if the government shuts down. So the Office of Management and Budget told government agencies to prepare for big layoffs of federal workers if the government shuts down on Tuesday. Federal workers in past shutdowns are typically temporarily furloughed until a budget deal was reached. Congress has yet to reach a stopgap funding deal that would avoid a shutdown next week. Democrats are holding firm on demands that any legislation must include an extension of the Affordable Care Act's enhanced tax credits, which are set to expire at the end of the year. They also want a whole ton of other just absolutely ludicrous and crazy stuff. They want money for a whole bunch of money for illegal immigrants. Not going to happen. They want, I think in total they're asking for like $1.5 trillion. Again, this is fantasy land, not going to happen. We have a federal budget deficit, an annual deficit of $1.9 trillion right now. There is no way with us running almost a $2 trillion annual deficit that they are going to get another $1.5 trillion. As far as I'm concerned, they got a gift from the Republicans in basically December of last year, January of this year, as the administrations changed over. They got a gift because they basically just did a big continuing resolution that just carried forward the Pelosi-Biden spending package from the last couple of years. So their big spending package just continued for the last 9 months without really any interruption. And now they're coming back saying, we need another $1.5 trillion. It is just not going to happen right now. There's no chance that this is going to happen. So if there is a government shutdown, I think that this is like, for the Democrats, I think this is the worst possible thing right now because number one, their favorability rating right now is at an all-time low. And if they shut the government down, this is what's going to happen. They're going to play right into the Trump administration's hands. They're going to hand them the mass firings that they have been seeking all year long that have been held up in the courts. because every judge in America apparently just loves to just hold everything up. So they could be handing them this giant win on a platter. And yet at the same time, if they don't shut the government down, they go back, they're not going to get this 1.5 trillion in spending. So then their base won't be happy with them for that. So they're really in a lose-lose situation here that's not good. Now, in the meantime, this could have some what I would call some mild effects in the short term where, you might get some people that aren't getting paid for a month or two while this drags on and doesn't work out. There could be some programs like welfare benefits and other things like that could get hurt. So there are definitely some other things there that would not be good, I think, for either side of the aisle for that matter. So, but like I said, this is the big thing. Obviously, you've got this massive government shutdown looming here. And again, not good. And I think this, like I said, Tuesday is the big day. If they can't come to something here, we could see something pretty crazy start to happen on Tuesday. So like I said, we'll keep an eye on that. But I want to get into some other news here. So now, earlier this week, and I'll get to this later in the show when I start talking about the episodes I put out this week, but on Monday of this week, I put out an episode, a very important episode about a company called Tricolor Holdings LLC, which was a subprime auto lender down in Texas. Now, and this was a huge episode. Everybody loved this episode, got a ton of views, got a ton of comments, feedback back from people. This was not really getting much coverage in the news media, and I could not understand why, because you have this potential multi-billion-dollar loss on our hands here, and this could be something that could trigger a much bigger issue here in the auto industry. And then this came out yesterday in the Wall Street Journal. Auto industry is flashing a warning sign on the U.S. economy. CarMax's sales and profit plunged in the latest quarter, sending the stock down 20%. So the auto industry is flashing warning lights on the state of the U.S. economy. Automakers' profits are getting squeezed by tariffs. Subprime auto lender recently collapsed. That would be Tricolor Holdings. And some car retailers are warning that consumers are pulling back. CarMax, the biggest seller of used cars, said Tuesday that its sales and profit plunged in the latest quarter. The company's results, which sent its stock tumbling 20%, is the latest in a series of unsettling developments in the industry under strain from President Trump's tariffs and car makers' recalibration of expensive electrification strategies. The consumer has been distressed for a little while. I think there's some angst, CarMax chief executive Bill Nash told analysts on a call Thursday. Consumers with better credit profiles seem to be sitting on the sidelines. Now, let's see here. Tricolor, a subprime auto lender and car dealer owner, abruptly filed for bankruptcy liquidation earlier this month amid government investigations and a bank partner's allegations of fraud. The Dallas-based company offered auto financing to customers who lacked the credit history or a social security number and operated 65 dealerships. Yeah, there's a little bit more to it than that. They were basically selling cars to illegal immigrants, undocumented illegal immigrants. That was their number one customer. And that's why this whole thing blew up. And now with the border being closed, with ICE agents basically looking to round up and send a whole bunch of these people back to, whatever country they came from, this obviously is putting a crimp on business. Now, what genius. And again, and I also, I cover a lot of this in the episode that I did, but like I said, I wanted to bring this front and center just because this was the most recent news on this. But what genius thought that it was a great idea that was the winning business model to basically sell all of your used cars to illegal immigrants? That's got to be a Darwin Award winner right there. And this thing is crazy because they sold a lot of their car loans, they securitized and sold, and basically BlackRock, bought, surprise, surprise, BlackRock right there to give these guys a stellar ESG rating. Isn't that wonderful? And bought up a whole bunch of their loans here. But now you've got Fifth Third Bank taking a $200 million loss. You have got JP Morgan potentially taking a $200 million loss. You got Barclays Bank looking at a $60 million loss. You've got this small bank called Origin Bank, I think in Louisiana, looking at a $30 million loss, and a $30 million loss that they can't really take because I think they're only like a $400 or $500 million bank. That would be catastrophic for them. And as a matter of fact, the CEO of Tricolor Holdings was on the board of Origin Bank, and basically that's how he got them to, take a whole bunch of these bad loans from them. But this breeds the question there. Was CarMax? I would ask the question to CarMax. CarMax, your sales drive, you're the biggest seller of used cars, and all of a sudden you have your used car sales plunge. Were you basically doing the same thing that Tricolor Holdings was doing? I think that's a fair question to ask. What were some of your sales practices? Were you selling a bunch of subprime auto loans? That might be a good question there. And again, they point out that people with better credit scores are sitting on the sidelines. Yes, I would concur with that. Yeah, I think they are. And part of the issue here is that cars have gotten so insanely expensive. I mean, insanely expensive. I mean, you're out there looking at a lot of trucks and SUVs, all these vehicles, $75,000, $85,000, $90,000. You now have, I think it's 33 or 34 car models that are all over $100,000 for a brand new vehicle. 33. I think you only have about 20 vehicles, and again, this is across all the car brands, like, so BMW, Volkswagen, GM, Ford, Toyota, everybody. I think you have a total of about 20 car options out there that are basically $30,000, or a minimum of 30 grand for a new car. Like, I mean, cars have just gotten way too expensive. And again, I'm not sure, and it's kind of crazy because I can remember going back to, and I just say this, going back to 07, 08, I can remember sitting there, and this is, probably like 2010, like, about a year after the market hit rock bottom, and basically all the big three had to all get bailed out, right? Ford had to get bailed out. GM had to get bailed out. Chrysler at the time, which is now owned by Stellantis. They all had to get bailed out. And I can remember going, because again, I'm over in like the Philadelphia area, so they have the Philadelphia Auto Show is a big deal every year. I remember going to the Philadelphia Auto Show back in 2010. I remember looking at the prices, and I remember sitting there thinking to myself at the time, well, gee, these automakers, they're probably going to have to drop their price tags because they're going to need to, get their volume back up, and they're going to need to lure people in. So they're probably going to give people some pretty good incentives to get them to come back and buy cars, right? Nah. I was shocked to see that the prices just kept going up. The prices, they never came back down, which to me was just always wild. And I think that no matter what has happened, in our economy, no matter what is going on, you just see the prices of vehicles just continue to go up and up and up and up. Now, then the car companies pivoted to the big electric push. They were all going to stop. They were all going to stop making combustible engines. Everything come 2030 was going to be fully electric. The Biden administration went on this insane push, and they said, "Oh, we took all this money and we're gonna start building all these electric charging stations." And they took, I don't know, whatever it was, $50 billion, and I think they built one electric charging station. I mean, it was, and then the electric charging stations that they had built, which is almost comical, were basically running off of diesel fuel. Diesel fuel generators were powering these electric charging stations. So like you couldn't make up how insanely, like, just ridiculous this whole thing was. So and thankfully with Trump coming back in, he put the kibosh on all that and said, no, we're not going to go all electric. We're not doing that. And I think that's been a great thing, but undoubtedly you're seeing the impact here of the immigration issue. The immigration issue is coming front and center now in the auto industry. And this could be, this failure of Tri-County Holdings. Like, again, I would not be shocked in the coming months if we basically unfold. And of course, you've seen this mad scramble amongst all these different banks to try to, quote unquote, secure their collateral. Which again is standard operating procedure for any bank. You have something go bad, you try to scramble to knock down your collateral. But again, who are you going after to get this vehicle? You're going after an undocumented illegal immigrant who shouldn't have been here in the first place. And good luck collecting that car. Good luck going after and getting that vehicle. But then here's what's even worse. And it gets, I mean, because this thing gets so much worse. What Tricolor Holdings was doing to their customers was they were abusing these poor people. They were taking any used piece of crap car that they had and they were selling it to them. And then if the car was busted, if it was a lemon, if it didn't work, these people would bring it back and they would say, "Oh, gee, hey, sorry about that. But I'll tell you what, you go complain to, who are you going to go complain to? Exactly. There's nobody for you to go complain to. But I'll tell you what we'll do. We're happy to sell you another car. We'll sell you another car over here." And this is the, and then people, they're saying, "Oh, I brought my car back. I had a warranty, whatever." They wouldn't honor the warranty, or it was broke. It was, so I mean, they were just absolutely taking full advantage of these individuals. And it's just horrible. I mean, the whole thing is just horrible all the way around. And, I would not be surprised one bit to see this turn into, say, like a multi-billion-dollar failure after all this is done. And the question is, will this begin to kick off a domino effect in the auto industry? That is the big question here. And I think that what you're seeing here with like CarMax, this is very interesting stuff here. And we'll see, what continues to happen with this, how this continues to unfold. Like I said, I will keep everyone updated on this. And like I said, I'll talk a little bit more about this when I get to my episode review a little bit later on in the show. But let's move on to some other things here. So let's look at some economic indicators for the week, because we had some really interesting things that happened. So first of all, the second quarter GDP was revised sharply higher to 3.8%, the best quarter in 2 years. So it started off, it was reported that GDP for the second quarter was 2.960%. 1 month later, it was revised higher to 3.29%. And moments ago, and again, this was from yesterday, or from Thursday, the Bureau of Economic Analysis reported that second quarter GDP was revised once again, and even higher this time, to a whopping 3.83%, the highest print in nearly 2 prints since the 4.7% in the third quarter of 2023, and primarily reflecting an upward revision to consumer spending. So remember how we've been hearing that consumer spending was in the tank and was going down. Apparently not so much. So according to the B, again, the Bureau of Economic Analysis, the increase in real GDP in the second quarter primarily reflected a decrease in imports, which are a subtraction in the calculation of GDP, and an increase in consumer spending. These movements were partly offset by decreases in investment and exports. Compared to the first quarter, the upturn in real GDP in the second quarter primarily reflects a downturn in imports and an acceleration in consumer spending that were partly offset by a downturn in investment. Real final sales to private domestic purchasers, the sum of consumer spending and gross private fixed investments, increased 2.9% in the second quarter, revised up 1 percentage point from the previous estimate. So here are the details. So personal consumption contributed 1.68% to the bottom line GDP print of 3.8%, or nearly half. This was revised higher from the 1.07% in last month's revision. Fixed investment was also revised higher to 0.77%. The change in private inventories was revised lower, subtracting 3.44% from the bottom line print. Net exports was also revised slightly lower. And then government was flat, subtracting a negligible 0.01% from the GDP number, down from negative 0.03 previously. So of the above, the most notable revision was that of personal consumption, which surged from 1.6% to 2.5%, despite clear signals that the average U.S. consumer, middle class, if not so much the top 1%, is hurting. So before Thursday's figures, the Federal Reserve Bank of Atlanta's GDP Now estimate penciled in a 3.3% rate of growth in the July-September period. However, economists are less upbeat about growth in the fourth quarter, as weaker employment dims prospects for consumer spending. Okay, fair enough. But again, the GDP numbers are now very strong so far for this year. They're expecting this to be lower. Does that mean substantially lower? So, I mean, 3.8% is a great great number. That's a fantastic number, considering the fact that the GDP for the first quarter wasn't that great. But this puts the average for the first 6 months of the year up over 2%, which is fantastic. And I would imagine that we're going to see, I would say probably low threes for the third quarter and probably something in the twos for the fourth quarter. So, but overall for the year, we'll probably end up somewhere in the 2.5% range, which is fine, which is just fine. It's again, not like a stellar year, not like a robust year, but certainly not bad. Certainly not the worst thing we're seeing. But again, the problem with this is that it begins to, again, all of the Chicken Littles out there, all of the, again, I bring you guys this news on economic indicators every week, and this is why I began to really question a lot of the consumer sentiment numbers that we were getting from the Michigan consumer sentiment, some of the other ones that are out there, and they're all just like, oh, negative. And I'm just sitting there looking at this and I'm going, the numbers, these things are not matching up. The numbers that we're getting are not matching the consumer sentiment that's coming back. Now, to be fair, I will say there are a number of things that lead you to know that the consumer is under a lot of pressure. Inflation has remained slightly elevated at hovering around, 2.5% to 3%. You have credit card debt at an all-time high. You have student loan debt payments that have kicked back in. You have interest rates that are the highest that they've been in quite a while. So all of those things combined definitely put a lot of pressure on the consumer, no doubt. However, we're still seeing the consumer hanging in there. We're still seeing the consumer spending being relatively pretty good, which is a great thing at the end of the day. So, and then here's another article here. GDP revision shows U.S. economy grew more than previously thought in the second quarter. The figures were revised upward due to an increase in consumer spending, indicating the economy is staying resilient in the face of headwinds from tariffs. The revised figures suggest the economy stayed resilient amid President Donald Trump's trade wars, which economists say have slowed down hiring and stoked inflation, at least temporarily. So I got a couple thoughts on this one here. So first of all, Investopedia. I show you guys these articles here, and I'm going to show you an article here from Investopedia and just another article here in just a minute, which is just totally ridiculous. But I like to show these Investopedia articles because Investopedia, I like the site. They do put out a lot of good stuff, but they can be at times highly biased. And I'm going to show you exactly what I'm talking about in a minute with another article. But it's constantly with the tariffs. There were dozens of articles on Investopedia about how at the beginning of the year the tariffs were going to wreck the economy, and tariffs, and Donald Trump's trade wars. I would just ask everybody, do we really have trade wars? I feel like these are more trade negotiations than trade wars. And we've seen deals now with a lot of countries. Does that, and I think that a lot of the countries out there that have been resisting this have really foolishly been resisting it. And why do I say that? Well, let's take a look at something here for a second. I want to show you guys something here for a second. So, let me blow this up here so everybody can see this a little bit. So here is, I don't know if anybody follows Finance a Lot on X, but I highly suggest you go follow him. He puts out some great stuff, puts out a lot of great, he finds these great little like finance documentaries, which I love, which he puts out. I've watched a bunch of them, but he does a great job on there, has a lot of good commentary. But here's a video. And unfortunately, I can't play the audio here for you already, but this is Mark Carney's. This is Canada. Their budget officer just warned that Canada's fiscal situation is so bad that the country may collapse. The country may collapse. That's because they're not getting the $250 billion surplus from us that they're used to getting every year. And all of a sudden, their tariffs to us got jacked up, because they weren't, they stupidly came out and basically said, oh, no, we're not going to negotiate. We're not going to do anything. So now they're feeling. So then here's another one. Elections have consequences. Canada voted for its own downfall in 2015. Justin Trudeau destroyed Canada with economically illiterate policies. At the same time, he opened the doors to millions of third world unskilled migrants, driving down wages and increasing housing costs. Yes, absolutely, 100%. And let's take a look at another one here. Peter St. Onge. If you don't follow him on X, I highly recommend him as well. Peter is a super intelligent dude who does a lot of great work out there. But and he talks about here. Well, this is an article on academic studies, which is a whole nother topic for another time. But here's what I wanted to look at. So this was he was talking about this. This was the now he calls it a trade war enough. But the trade war is crushing Mexico, where exports to the U.S. make up 1 in 3 jobs. Retail sales are down 9%. Construction is down 18%. Foreign investment plunged 21%. Mexico is in recession under Uncle Sugar as Uncle Sugar takes away the freebies. In their main export hub, Juarez, an estimated 1 in 5 jobs are already gone. If Trump renegotiates USMCA as he promised, that could double. So again, I think that Mexico and Canada again, you could call it a trade war. You could describe it as that. I don't really see this as a trade war because in my mind, in a trade war, everybody's got to be losing, right? But right now, it's not the U.S. losing. It's all these other countries losing. The big one that we can lose with is China, because China does have sway over us. We have intertwined our economy with China to such an extent that any type of decoupling from China will undoubtedly cause us some, rare earth minerals is a great, example of that. We are so dependent on China for rare earths. So if you try to decouple from China, that could cause us a lot of problem. Would that ruin us? No. As a matter of fact, like say in a hypothetical world, say we fully decoupled from China, would that be the end of the U.S.? No, absolutely not. We would take it on the chin for a few years. We would begin to rebuild much of our manufacturing base. We'd figure a way to make it work. And long term, we would still be fine. Okay. China's economy, however, would just be crippled and destroyed overnight. Okay. Without access to the American capital markets, without the access to the American consumer who buys all the junk that they make for us, their economy would be finished. It would be finished, not slightly down, not a recession. It would be finished. But we would get pretty beat up in that kind of a decoupling as well. So like I said, so the trade war thing I think is interesting, but and then just the whole thing on tariffs is just like we're not seeing this. We have not seen this massive influx of inflation from tariffs. We just have not seen it. And okay, but let's look at some other economic indicators here for a minute. So jobless claims tumbled to 218,000, well below estimate, despite fear of a labor market weakness. So jobless claims total a seasonally adjusted 218,000, down 14,000 from the prior week's upwardly revised figure, and significantly less than the consensus estimate for 235,000. Gross domestic product posted a 3.8% gain. We talked about that. Spending on long-lasting items such as airplanes, appliances, and computers increased 2.9% in August, compared with the forecast for a decline of 0.4%. So, initial claims for unemployment insurance were well below expectations last week, helping to douse caution at the Federal Reserve and elsewhere that the labor market is in danger. First-time filings for the week ended September 20th totaled a seasonally adjusted 218,000, down 14,000 from the prior week's upwardly revised figure, and significantly less than the Dow Jones consensus estimate for 235,000, the Labor Department reported on Thursday. Continuing claims, which run a week behind, were little change, falling $2,000 to $2,000 jobs to 1.925 million. The release comes just a week after the Federal Reserve lowered its benchmark interest rate. So again, nothing catastrophic here with the seasonally adjusted jobless claims, but again, just something good to note, something good to look on, that you're not seeing this like total collapse of the unemployment market, so to speak. Now let's take a look at home. So I got a couple of home things for everybody here. So the first one, new home sales soar 20% in August to a 3-year high. Sales of newly built homes rose a much larger than expected 20.5% in August compared with July, according to the U.S. Census. That's despite mortgage rates that are higher than they are today. The median price of a new home sold in August was $413,500, an increase of 1.9% year over year. So we have new home sales surging in August, but existing home sales stall in August amid higher mortgage rates. So sales of previously owned homes were essentially flat in August. The median price of an existing home sold in August was $422,600, up 2% from a year ago. Supply fell 1.3% last month from July, although it is still up 11.7% year over year. So new home sales doing pretty good. Existing home sales not doing so hot. And let's take a look at mortgage. So mortgage demand stalls after a mini refinance boom. So total application volume rose 0.6% last week from the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Refinance demand, which had surged to the highest level since, rose just 1% for the week, but was 42% higher than the same week 1 year ago. Mortgage applications to purchase a home were essentially flat, up just 0.3% for the week, and up 18% from the same week 1 year ago. So I think now, let's see here. Does it give more? Okay, yeah. So mortgage rates basically hovering in at around 6.34%. They were down slightly from the 6.39%. They had gotten down as low as 6.25%, or maybe even 6.21%, but then they crept back up a little bit. I would be on the lookout, because I would say by the end of the year, I think that interest rates will probably come down to maybe about 6%. That's my guess right now. Maybe a little over, maybe 6.10. Something in that neighborhood, but I'm saying 6% to 6.10 is, I think, where mortgage interest rates will probably be by the end of this year. I think it's going to be a little bit of a slow burn in getting them to come down a little bit. A lot of it depends on the Treasury market and, just the sales, what the U.S. Treasury does with the sales of the U.S. national debt. So we'll have to keep an eye on that. But again, just to recap here real quick. So new home sales soared 20% in August, while existing home sales stalled in August. And we saw a mortgage demand stall after this mini refi boom that they saw happen here over the last month or so, as rates began to come down here a little bit. So that's basically what's happening here in the mortgage market. But now let's turn our attention back to inflation for a minute here and get a little bit of Fed news at the same time. So the Fed's favorite inflation measure stayed stubbornly high in August. Now, what they're talking about here is the PCE. The PCE inflation index, which is the Fed's preferred inflation index. So consumer prices rose 2.7% over the year in August, as measured by PCE inflation, up from 2.6% in July, while core prices, excluding food and energy, rose 2.9%, the same as in July. So prices are increasing faster than the Federal Reserve's goal of a 2% annual rate. The uptick was not surprisingly high, so the Fed likely remains on track to continue cutting its key interest rate despite inflation concerns. So again, nothing really shocking here. Inflation didn't drop, but it really didn't go up. It didn't, again, nothing here that was surprising or exacerbating, or anything here that would have shocked the Fed to a point where they would have said, whoa, we need to pump the brakes. Can't do any cuts in October. We need to pump the brakes. So no, we're not seeing any of that. Now, again, you kind of couple this, if we go back here to the jobless claims here. So again, jobless claims, 218,000. Then we see the PCE, just staying steady. So again, all these things kind of add up. They give the Fed cover to basically say, okay, we will cut the rate, but we're not going to be uber aggressive with the rate cuts, because we're not seeing this massive spike up in inflation. So that doesn't mean we're going to stop cutting. And we're not seeing this super quick deterioration of the labor market, which means that we don't have to cut like 50 basis points at a time. We could take our time with it a little bit, if you will. So now let's look at some other things. So now Jeremy Powell spoke this week, and Powell warns that the Fed faces a challenging situation in setting interest rates. No bleep. You know what? Yeah, because we didn't know that, right? Thank you, Jeremy. We didn't know that. This just in, Jeremy Powell's in a challenging situation created by his own actions over the last 16 years. Shocking, breaking news. See that? Look, I break news on the channel. See that? Fed Chair Jeremy Powell said the economy is pulling the central bank's policy in two different directions as the job market weakens while inflation remains elevated. The central bank has started cutting interest rates, but could change its strategy if inflation gets worse. Two other Fed policymakers spoke Tuesday, with one advocating for gradual rate cuts and the other for more decisive cuts. Federal Reserve Chairman Jeremy Powell said there is no easy answer as the Fed grapples with whether to use its key interest rate to fight inflation or to boost a struggling job market. Powell covered familiar ground, speaking Tuesday at an event in Rhode Island, highlighting the dilemma of the Fed's dual mission to control prices and boost employment at the same time. Powell gave no indication as to when the Fed would reduce rates again after cutting last week for the first time this year. We only have one tool, which is monetary policy, really interest rates. And the situation is calling for different answers, Powell said. It's a very difficult policy environment when your two goals are telling you two different things. You've got to make a compromise. So let me ask everybody this question here. Why is it now all of a sudden in years past when Biden needed something to happen, when Obama needed something to happen, the Fed has dozens of tools in their toolkit. They have this thing called forward guidance where they would basically give you hints as to where things are going. But Jeremy basically has no time for forward guidance. Basically he's just been, nope, I'm not doing nothing to help anybody. I still think that Jeremy having to cut that interest rates 25 basis points was one of the most painful things he's ever had to do. But here's the bigger thing. The Fed has caused this entire situation by their actions over the last 16 years. That's the thing they always leave out. They want to talk about the tariffs. Oh, the tariffs did this, the tariffs did that. Oh, I'm sorry. I didn't know that the tariffs were the reason that the Fed kept interest rates at 0% for the better part of 10 years. I didn't realize that it was the Trump tariffs that did that. I didn't realize it was the Trump tariffs that caused them to do quantitative easing to the tune of trillions of dollars for a better part of a 10-year period of time. I didn't realize that. I didn't realize that in 2019, it was the Trump tariffs that allowed the hedge funds to take over the treasury market with their basis point trade. I'm sorry, not the treasury market, the repo market, and basically almost completely blow up the repo market bound in 2019. But this, this little thing happened at the beginning of 2020 that basically wiped all that off of the front page of the newspaper. So everybody forgot all about that. But I didn't realize that all those things that the Fed has done over the last 15, 16 years, suddenly that all happened just because of tariffs. Tariffs are the explanation for all of that, of course. Jeremy Powell's here, and he's just, he can't, I've said this before, Jeremy he can't hide his disdain. He hates Trump. Okay, we get it. You don't like Trump. We hate it. But why do you got to punish the rest of the country for this? That's always been my question. I get that you don't like Trump. Okay, that's fine, dude. But why do you have to punish the rest of the country? When Biden was trying to get reelected, you had no problem cutting the interest rates 100 basis points and giving us a 50 basis point rate cut last September. But now, and he lowered rates when he shouldn't have lowered rates. I said last September, October, November, I was screaming, don't cut the interest rates because you're going to reignite the inflation. And that is exactly what happened. And yet now that things have gotten better, and now it's been clear for the last 6 months that now it's safe to lower interest rates, and he refuses to do it, which is just mind-boggling. So, but at least now they're starting to come around and admit that, oh well, yeah, maybe we shouldn't, maybe we maybe we should cut the interest rates finally, it's like, gee, you think maybe we could cut the interest rates before the job market implodes? That might be a good thing. So, but let's continue on here. So then some other comments from this meeting. So the Fed Chief Powell says that stock prices appear fairly highly valued. Yes, you may say that. Federal Reserve Chair Jeremy Powell on Tuesday noted that asset prices, a category that typically includes stocks and other risk instruments, are at elevated levels. During a speech in Providence, Rhode Island, the central bank leader was asked how much emphasis he and his colleagues place on market prices and whether they have a higher tolerance for higher values. We do look at overall financial conditions as we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve, Powell said. But you're right. By any measure, for example, equity prices are fairly highly valued. So I want everybody to remember something. Going back to the days of Alan Greenspan at the Fed, starting in the early 90s, basically the Fed adopted a policy where they said a couple of things. Okay, they talked about asset price inflation. So you have asset price inflation, and then you have price inflation. So it's two different sides of the inflationary coin. Now, the Fed, starting at around 1992, basically said their policy was, we are cool, totally cool with asset price inflation. Because what is asset price inflation? That is the stock market going up. That's the value of your stocks inflating. That's the value of your home inflating, okay? And that creates what they like to call the wealth effect, okay? It makes everybody feel richer. When the irony of the whole thing is that you're actually not getting richer, you're getting poorer, because the value of your money is not going up, the value is going down. The value of the dollar has dropped 95% in the last 110 years. Meanwhile, the value of houses go up, the value of stock goes up. So they again, the Fed's policy is they deem asset price inflation as a great thing. However, price inflation, totally different thing. Price inflation is the big no-no. Now, why do you think that price inflation is the big no-no? Well, because it gets back to politics. It gets back to politicians. Politicians don't like price increases because if everyday prices on things go up, people generally get pretty mad at the politicians, which means that they don't normally get reelected. That's why they don't like price inflation. They don't like the prices of everyday items going up, but they're totally fine with asset price inflation. Now you might say there, like, well, what's the big deal? Well, the big deal is that it's very difficult to control those two things. And I go back to what Jeremy Powell said about, like, oh, well, we just don't have, we don't have anything in our toolbox. The only thing we have is interest rates. And it's like, no, that's not true at all. You have a lot of tools in your toolbox. You showed that when you did quantitative easing. You showed that when you did Operation Twist back in 2011 and 2012. So the Fed has the ability to manipulate a lot of things in the market. They could mess with the amount of money in the economy, for example. They can work with the repo market. They have a lot of tools in their toolbox. So for Jeremy to make a statement that, oh, we just don't have anything, to work with, I mean, it's ridiculous. It's ridiculous on its face. But again, they're totally fine with the asset inflation. Asset inflation, totally fine. They just don't want the price inflation is what they don't want. But let's see here. Now, here's interesting. I'm going to show you guys 3 articles here from 3 Fed governors with totally different takes on what's going on here. So the Fed's Mirren. Now, remember, Stephen Mirren, he literally just got put on the board like a week ago. So the Fed's Mirren, now he's calling for slashing main interest rates to avert job losses. So Federal Reserve Governor Stephen Mirren brushes aside concerns that he has weakened the central bank's independence by not resigning as the top White House economic advisor. And again, so why, just real quick, why didn't he resign his job? Well, because he's only appointed to the Federal Reserve Board for a couple of months. In January, he drops off the board. He's going back to his regular 9 to 5 job, so to speak. And they're going to have to elect and nominate somebody else to take over the seat that he basically just took over. He's only in there for literally a few months. That's why he has not resigned his position. But he is basically advocating for a lot of cuts. He wants to see a lot of rate cuts, and he wants to see the cuts happen very rapidly. Now, do I think he's going to get that at the end of the day? No, I don't. I think I think the best thing that we can hope for out of the Fed is that basically they just keep doing quarter point rate cuts over the next couple of meetings, and that we eventually get down. And again, I have said, it's been, for whatever my 2 cents are worth, I have said that I think the sweet spot is to get rates down by 100 to 150 basis points. I think that is the magic number. If you can get rates back down into the fives, you can get commercial rates back down into the fives from the, 6 point, in the commercial world, you go to get a commercial mortgage, you're probably looking at 6.75 to 7%, maybe even 7.25. Right now, if you can get those rates back down into the fives, if you can get them back down 5.5, 5.25, you again, the commercial world is going to see a flurry of activity at that point. Same thing in the residential world. If you can get mortgage rates back down into the fives, I mean, they're flirting now with like the lower sixes, like we just said a minute ago, it's 6.34. But if you can get that back down into the fives, if you can get the mortgage rates back down to, again, 5.5, 5.25, that is really going to jumpstart or help to jumpstart the residential mortgage market. So that's what we're trying to get to. That's what we're trying to see. Now, do we need interest rates from the Fed to get cut down 200, 300 basis points? No, I would say no, we don't. And there's a couple of reasons for that. First of all, number one is you don't want to go back to what's called ZIRP. We don't want to go back to zero interest rate policy because we saw how bad that was. So we do not want to go back to that. The second thing is that if we do run into a recession for any reason, if you've cut the rates all the way down and we do hit a recession, there's nowhere to cut. There's nothing to cut because you've already effectively almost taken the rates back to zero. So you want to leave yourself with a little bit of, breathing room in there, but that being said, and here's the other thing. This is where I agree with Stephen Mirren. Should they be a little bit more aggressive on the rate cuts right this minute? Yes, I think they should. Like, in other words, could we do 50 points at the next meeting? Yeah, I think they should. Should they do 50 points again in December? Yes, I think that should, because that would take us down 125 basis points. Perfect. That's great. That's where we need to be. And then take a break for a few months. Take a break in January and February. See how things are looking. And then maybe come back with one more quarter point rate cut and see how the momentum, see what's happening in the economy at that point. So I agree with Stephen Mirren again on some of these things, but do I want the rates to come down as much as what he's advocating for? No, I don't. But we still need rate cuts, and I think they should be a little bit more aggressive. And why do I think they should be a little bit more aggressive? Because the Fed has waited too long to cut rates. They should have been cutting rates 4 or 5 months ago, and they've been waiting. So that's why I think that the Fed should be a little bit more aggressive right now in some of the rate cuts and some of the things they're doing. But so this is Stephen Mirren's opinion. He wants to see more aggressive rate cuts. But here we have a couple other Fed governors. So the St. Louis Fed president, Musalem, he sees limited room for more interest rate cuts. So the St. Louis Fed president, Alberto Musalem, on Monday reiterated his support for last week's interest rate cut, but said he is weary about going much further. I believe there is a limited room for easing further without policy becoming overly accommodative, and we should tread cautiously on further reductions. Okay. And then here is another one. Chicago Fed President Goolsbee says officials have to be careful not to get too aggressive with rate cuts. So Chicago Fed President Austin Goolsbee expressed caution about lowering interest rates as the U.S. economy grapples with the forces of slower growth and a weaker labor market, with inflation having been over the target for 4.5 years in a row and rising. And whose fault is that? Whose fault is that? That's his fault. I think we need to be a little careful with getting all ready up front, getting really upfront aggressive, he told CNBC. So again, these are, I would point out to people that these are the Jeremy Powell acolytes on the Fed board. These are the people in the groupthink echo chamber that is the Federal Reserve. That basically are just, these are the people that are holding out, saying, no, we don't need to do anything. Here's another one. Fed's Bostic sees little reason to cut rates further for now. Atlanta Fed president says risks of weaker employment outcomes have risen, but years of elevated inflation remain a serious concern. So Ralph Bostic is hesitant to support further rate cuts in October due to persistent inflation concerns. Bostic said in an interview that he penciled in only one rate cut for all of 2025 at the Federal Reserve's meeting last week because official cut rates last week. That suggests Bostic doesn't currently anticipate the need for another reduction at either of the two meetings remaining this year. He said he had filled out those submissions with a very light pencil, underscoring low conviction over the right path for rates, but he said he remains more nervous about inflation continuing to run above the Fed's 2% goal. I am concerned about the inflation that has been too high for too long. That's funny. They weren't concerned about this a couple years ago, but all of a sudden now it's a problem. This year, all year long, this has been a problem. So now here again, you have three Fed board members that are all telling you right now that they don't want to cut rates. They don't see the need for further rate cuts, and they don't want to cut the rates. You got one governor here, Mirren, who's telling you, yeah, we need to cut rates and we need to be more aggressive. And you've got St. Louis Fed President Musalem saying no. You've got Goolsbee saying no. And you've got Bostic in Atlanta saying no. So, so again, so when you look at this now, when you take all these articles into consideration, you begin to see a different picture here. Again, we need rate cuts. We need action on behalf of the Fed, but you've got a lot of people over there that are basically like, nah, we don't want to do it. We don't want to do it. We don't think we need it. So again, it is a problem. This is a problem. Okay. A couple other articles here on this. So, how concerning is inflation right now? Fed officials are divided. So on Monday, several Fed officials explained why they think the central bank should be reluctant to cut its benchmark interest rate in the months ahead, while one argued for steep cuts. Exactly what I just showed you. Three policymakers said inflation is running too high for comfort, at least partly because of President Donald Trump's tariffs. What I just showed you. Trump appointee Stephen Mirren said tariffs are not pushing up inflation and that inflation will come down on its own because of Trump's immigration crackdown. Yes, I agree with him 100% on that. I've been saying that all year long so far. So again, I already showed you that. So that's what we're seeing there with that. But now let's go to this. So inflation is running high. Here's what experts expect for the rest of the year. So forecasters expect inflation to accelerate in the last part of the year as more companies pass the costs of President Donald Trump's tariffs on to customers. A survey of professional forecasters called for a consumer price index to rise 3% over the year in the fourth quarter, an acceleration from 2.9% in August. Oh, wow. That is a massive spike. It's going to go from 2.9 to 3%. That is just man. Hey, let's just throw in the towel right now. It's all over. Forget it. What else can we possibly do here? It's all over, folks. I mean, come on. This is ridiculous. This is the fear mongering. It's going to go from 2.9 to 3%. And that's the concern. Some economists expect here's the humdinger right here. Some economists expect inflation to peak in December and then fade in 2026 as tariff-related price hikes cease. So again, all this gnashing of teeth by these Fed presidents, and what they really think is going to happen is that this inflation is going to peak in December and then begin to fade into 2026. But in the meantime, we've all got to deal with, we've all got to watch the labor market continue to implode. And we've got to struggle with the government refinancing debt, with the mortgage market, both commercial and residential, being somewhat in the toilet. because we can't, people can't afford to buy a house. They can't refinance stuff. I mean, this is ludicrous. But I wanted to show this to everybody because, again, the Chicken Little fear mongering is unbelievable. And, the forecasters expect inflation to accelerate in the last part of the year. But this idea of this acceleration is laughable. It's going to go from 2.9 to 3%. Like, what? I mean, give me a break, man. And at the same time as they're fear mongering over what's going to happen here over the next few months, they're also telling you that, yeah, it's pretty much going to peak probably at 3% here in November, December. And then starting next year, it's all going to begin to go back down. Because we're going to see these tariff-related price hikes cease, because most of the countries have already signed the agreements, and we know what the costs are going to be, and that's basically that. And the tariff revenue is just rolling in, and it's unbelievable. Now, what does Wall Street think of all this? Okay, what does Wall Street think? So Wall Street bets rates will drop much more than the Fed's forecast. So future markets show investors bet rates will fall below 3% by the end of next year. So again, this is what the future markets are telling you. The future markets are telling you, they're signaling to you that basically, despite this rhetoric, that they think the Fed is going to cut rates. That is their expectation. So here's the Fed in the red line on this chart here. I'll make this a little bit bigger here so that everybody can see this. So the red line here on the Fed is here's the Fed right here. We cut 25 basis points. Okay. Here's where the market's sitting here going, yeah, we need to be down below 3%. So exactly what I was telling you, basically we need, a point to a point and a half. And that's basically where the market thinks that we're going. So Wall Street thinks interest rates are poised to come down faster than the Federal Reserve does, a wager that is already boosting the economy and markets by making it cheaper for Americans to borrow. Bets in the futures market show investors expect that the Fed's benchmark short-term rate will fall just below 3% by the end of the year from slightly above 4% right now. That marks a sizable shift from May, when investors thought the rates would fall only to around 3.5% by the end of 2026. It is also below what most Fed officials are forecasting. Their latest dot plot showed a median expectation that rates next year at 3.4%, the equivalent of 2 fewer quarter-point rate cuts than investors are anticipating. With stocks at record highs, investors are hoping that they can have it all, substantially lower rates without that much risk of recession. Some warned that they could end up disappointed. But again, it just goes to show you where the market is at. The market is expecting that despite the Fed's rhetoric, they're seeing more rate cuts than what the Fed is projecting right now. And they're seeing that basically the rate cuts to come down to the level of where I think it should be, which is somewhere in that 1 to 1.5% range. Okay, let's switch gears here for a minute. Let's talk about the latest with the Lisa Cook drama, the Lisa Cook Fed drama. So we had a couple very interesting updates here in the last few days. So Fed independence reaches its moment of truth as the Supreme Court weighs Cook's fate. So the High Court to decide whether Trump can remove board member, which former officials see as threat to central bank independence. So now this was on the 25th. So this was on Thursday. So the Supreme Court is poised to decide whether President Trump can remove Lisa Cook from the Federal Reserve Board in a case that economists and former Fed officials say threatens to severely erode decades of central bank independence. Trump's broad challenge over interest rate policy, which began with sustained criticism, but his move to direct action to remove governors, represents an existential crisis for the Fed, said Ethan Harris, former head of global economic research at Bank of America. The Trump administration has asked the Supreme Court to overturn lower court rulings that said Cook could stay on the job while she challenges the White House's attempt to fire her. A ruling in favor of the White House wouldn't necessarily be the final word on the matter, but analysts said it would be a crucial development that opens the door for Trump to replace other Fed governors, flattening 90 years of legal precedent that insulated central bank officials from political control. It's sort of the nightmare scenario if you believe in Fed independence. I will tell everybody right now, I do not believe in Fed independence. I think Fed independence is ridiculous. It is a joke. All it does is, first of all, I thought it was the Federal Reserve, right? Meaning they are part of the government. I asked the question that if they're so independent, then why do they need our tax dollars to pay for their Taj Mahal building down there in DC? I think that's a legitimate question to ask. If they're so independent, why do they need my tax dollars and your tax dollars to go build their $2.5 million Taj Mahal? And the Fed independence, every time the Federal Reserve does something stupid, gets themselves in trouble, and lawmakers, the president, anybody starts talking about, you know what, maybe we need to revisit that Federal Reserve Act, and maybe we need to rein these guys in a little bit more, do a little something here. They immediately throw on their cloak of independence. Oh, you can't do that. You can't mess with us. We're independent. We're independent. I think the independence argument is a joke. And here's the thing. And again, and this is not a Trump thing. I felt this way about any president. Okay. If the central bank falls under the executive branch of government, therefore falling under the president, any president should have the right to fire people at the Federal Reserve, to fire the chairman of the Federal Reserve. If the chairman of the Federal Reserve is doing, because again, it gets back to the notion of, if the chairman of the Federal Reserve is doing a lousy job, how do you get rid of that guy? You can't. You basically cannot do it. If and I'm just saying, if the head of the Federal Reserve is an incompetent moron who is just driving our economy into the ground, what's the president supposed to do? Is the president supposed to just sit there and be like, oh yeah, nah, they're independent, they can do what they want? Yeah, sorry guys, there's just nothing I can do. Sorry about that. No, I don't think, and then you get into this very this very big debate about who has more power, the head of the Federal Reserve or the president of the United States. And this gets back, now you go back to the founding fathers, and you go back to Thomas Jefferson, you go back to James Madison, you even go back to Andrew Jackson, who basically made a lot of arguments that you cannot have a central bank with the head of the central bank being more powerful than the presidency, not the man, the office. The office of the president. You cannot have the head of the central bank being more powerful than the office of the presidency. You cannot have that. And I agree with that wholeheartedly. All of those ex-presidents, I agreed with all of them made fabulous arguments about the power of a central bank and about why why you had to rein that in. And we're seeing it. We're all living it. We've all been living it. So anyway, okay. So now we're waiting for the Supreme Court to make their judgment. But let's see a couple other things here. So here's the big thing. Former Fed chairs urge Supreme Court to stop Trump from firing Lisa Cook. So a slew of prominent Federal Reserve experts urged the Supreme Court to block President Donald Trump from firing a Fed board member. A brief supporting keeping Fed Governor Lisa Cook on the job while courts decide whether Trump can legally fire her. The outcome of the case would determine whether Trump can take over the Fed and get it to dramatically lower interest rates. A who's who list of former Federal Reserve and White House officials urged the Supreme Court to preserve the central bank independence and prevent President Donald Trump from firing Fed Governor Lisa Cook, at least for now. Every living former Fed chair, Janet Yellen, Ben Bernanke, Alan Greenspan, signed the brief filed with the High Court Thursday, as did former Treasury secretaries, White House economic advisors from both parties, and prominent academic economists. If Trump is successful, it would be the first time in history a president has fired a Fed governor. Let me say that again. If Trump is successful, it would be the first time in the history of the Fed, 13 years, 115, 112 years, the firing of a Fed governor. So they are bringing out the big guns, okay? The deep state the Fed itself, they are bringing out the big guns here to try to save the Fed. Okay, that's what this whole thing is. They are bringing out the big guns here, baby. And let's look at this. Another one. Cook's firing would be the death knell for Fed independence, according to lawyers. So attorneys for the Fed governor called President Donald Trump's cause for Lisa Cook's dismissal flimsy. Oh, I'm sorry. I didn't realize that mortgage fraud was flimsy. I didn't realize that. If I committed mortgage fraud, you bet I'd be going to jail. If you committed mortgage fraud, you would certainly be going to jail. But because a Fed governor, because she commits mortgage fraud, it's cool. It's cool. It's totally cool. It's flimsy. It's flimsy. No, I'm sorry. I'm going to say the same thing that I say. I blasted Grandma Janet Yellen. Okay, when Grandma Janet Yellen was the head of the Federal Reserve and then the head of the Treasury. Okay, as the head of the Treasury, I blasted her for her transitory inflation, because it was ludicrous on its face. And there is no such thing as transitory inflation. And they kept pushing this narrative, transitory inflation. And the reason why I was so upset about it was because she should be held to a higher standard. She was the head of the Federal Reserve. She was then the head of the Treasury. She is a highly educated woman. She has been around financial markets for 30, 40 years. She's getting paid $7-8 million to go give speeches at every major university in the land. She is not a moron. She knows what she's talking about. She said she used that word in transitory. She used it on purpose. She did it for political reasons. She became a political hack. And so I lambasted her for that, because I'm sorry, whether she likes it or not, she's held to a different standard than everybody else, and that everybody that walks in the street. And the same goes here for Lisa Cook. I'm sorry, you are a governor on the board of the Federal Reserve. I'm sorry, you are held to a higher standard, whether you like that or not. That is the case, okay? And you committed mortgage fraud. So sorry, you got to go. Several former Fed chairs and Treasury secretaries also weighed in. So again, they're just bringing out the big guns here to try to save Lisa Cook. And, but here is the big takeaway. And I love this, because you had all these people for the last couple of weeks. If Trump fires Lisa Cook, the markets will go into meltdown and this and that. Really? Markets won't care if Trump fires Fed Governor Cook, DOJ tells the Supreme Court. So President Donald Trump's firing of Federal Reserve Governor Lisa Cook for alleged misconduct would not cause financial market disaster, the Department of Justice told the Supreme Court. Solicitor General D. John Sawyer urged the High Court to let Trump's bid to fire Cook take effect while proceedings in her lawsuit against the president continue. Yes. Here's the stark reality. Nobody's going to care if Lisa Cook gets fired. I guarantee you that 90% of the country doesn't even know who Lisa Cook is. They would sit there and be like, Lisa Cook, some Fed governor got fired. Oh, well, it would mean nothing. Okay. And if the markets did drop, they would drop for all of about 5 minutes, and then they would recover. And that would be the end of that. It would be a giant nothing burger. But of course, again, they got to fearmonger. They got to do their thing. They got to fearmonger in the press. Trump's going to take away the independence of the Fed. The Fed will be over. The markets will be in disarray. It's so ludicrous. But let's take a look at something else here. Could this give us a hint at what might be about to happen here? Supreme Court lets Trump fire the FTC's Slaughter for now. So the Supreme Court allowed President Donald Trump to remove Rebecca Slaughter as a member of the Federal Trade Commission while the justices consider her case. The Supreme Court, in a 6-3 order, granted Trump's request to temporarily block the rulings from judges who had ordered Slaughter's reinstatement. Justices Keegan, Sotomayor, and Kajita Brown Jackson dissented. No shocker there. But again, this should give you a glimpse into what is about to happen. So my guess is that you are going to have the same 6-3 ruling on Lisa Cook, and the Supreme Court's going to say, yeah, you know what? if the Fed falls under the executive and the president Scott is the chief executive and he's got the power, you serve at the pleasure of the presidency. Guess what? Sorry, if you get fired, you got to go. Time to go. That's going to be my guess. And I think that this gives us a great preview of what we're going to see come here very shortly. So, okay, now getting on. All right, do I want to go into the HPV? You know what? All right, we're gonna take a break here from the news for just a second. I'll get to the HB1Bs in just a minute here. So this is the point of show where I like to talk about, the episodes that I put out in the last week. I like to talk about economic indicators coming up for this week. And I also like to give everybody just some general banking news of, things that are happening right now in the banking world. So we'll start with economic indicators for coming out for this week. So on Monday, September 29th, pending home sales. On Tuesday, September 30th, we get the Chicago PMI, the CB consumer confidence. We also get the JOLTS job openings for August. On Wednesday, October 1st, we get the ADP non-farm employment change, the manufacturing PMI, construction spending, the ISM manufacturing PMI, the Atlanta Fed GDP now for the third quarter. On Thursday, October 2nd, we get continuing jobless claims, initial jobless claims, and factory orders. And then finally, on Friday, October 3rd, we get the average hourly earnings, we get the non-farm payrolls, participation rate, and the unemployment rate. So that is all of your economic indicators coming up this week. And we got, a lot of stuff there, a lot of employment things to come, which is good. So we'll get a little bit better reading on the labor market here this week. So, okay. All right. So what did I put out this week? What were the 5 episodes that I had come out this week? So on Monday, I did SBA launches 7A manufacturers access to revolving credit, or what are known as MARC loan program. So the SBA has launched a new loan program focusing on manufacturers. So the 7A manufacturers access to revolving credit loan program will offer working capital to small manufacturers, which make up about 98% of all U.S. manufacturers. The 7A MARC loans of up to $950,000 will have 0 upfront fees, zero. So the MARC loan limit will be $5 million. Reviewed in this episode is an article from the Business Journal titled "SBA is waiving many loan fees, but only for one industry." An SBA press release from September 3rd and an SBA procedural notice. So again, I just wanted to get the information out there about this new SBA loan program for manufacturers. I think that this is a great thing. I think many manufacturers will benefit from this. And I think this will be a way to help if somebody does want to get into manufacturing. If you are looking to start a company that manufactures something, this SBA program could be a great way to help get you started. So then on Tuesday, I did an episode which was called With Interest Rates Set to Decrease, Where Can You Go to Get Yield? So as interest rates are set to decrease, U.S. Treasuries remain a go-to investment for income and safety, but are there other alternatives? So municipal bonds, agency mortgage-backed securities, and preferred stock are 3 potential alternatives. An additional consideration: what is better, a tax-exempt municipal bond or a taxable bond? So this episode reviewed a couple articles from the Wall Street Journal on this topic, and I thought it was a good thing out there for anybody that's maybe working in the corporate world. If you're managing the investments for your business, and you're basically saying, okay, interest rates are going to go down. What am I going to do, or what could I possibly do? Aside from looking at treasuries, municipal bonds, agency mortgage-backed securities, and preferred stock could be 3 potential alternatives for you to invest the money of either the bank or your business or yourself personally, and basically, try to get somewhat higher yields. And then on Wednesday, I put out capital markets are eager for banks to raise money, but how should it be used? So this was a very interesting article here from Bank Director that I covered. So capital markets are open for banks that need to raise capital, which is great. The question is, what will banks use the capital for? So outside of M&A, mergers and acquisitions, investors are going to be looking for banks to invest, raise capital in ways that will boost a bank's profitability. So at the same time, though, banks have a lot of pressing needs, particularly with technology. While all these needs are important, they do not all return an immediate impact to the bottom line. If a bank decides to raise capital, they will have to be very careful about how the money is invested. So again, yes, absolutely. So interesting episode there. And then on Thursday, is there an opportunity for community banks in multifamily lending? So national and regional banks have been pulling back on multifamily lending. Does that create an opportunity for community banks? The pullback in lending by the largest banks is due in part to higher interest rates on existing debt and tighter liquidity. So we consider some tips for community banks that could lead to multifamily lending success. So basically, and that episode reviewed a blog post from PCBB. So again, I think there could be a big opportunity for community banks there with multifamily lending. And then finally, yesterday on Friday, the episode I put out was what is myth versus fact for banks when it comes to stable coins. So, and we reviewed an article from Bank Director in this episode. And so with the passing of the Genius Act and other potential legislation on the way, banks will soon have a full regulatory framework around stablecoins. This new legislation has brought expectations around stablecoins, with some people seeing major change, while others think that not much will happen at the end of the day. So in this episode, we consider myth versus fact by reviewing an article from Bank Director titled Stablecoins and Banking Separating Fact from Fiction. So I think there are a lot of opportunities for banks out there as it comes to stablecoins, and not just stablecoins, but also digital assets in itself. But there's a lot of things that have to happen in there. And there's obviously a lot of concerns on behalf of banks. I think the bigger question is not necessarily of will banks do this, but how quickly banks will move with this. My guess is that they will not move very quickly, even though the opportunity is there in front of them, because of a myriad of reasons. Now, number one is, not wanting to run afoul with regulators. The risks of fraud and other illicit financial activities that could come back to haunt them. In other words, right now, TD Bank just got hit with the biggest fine that banks have ever seen. They got hit with a $3 billion fine for basically not complying with what's called BSA, Bank Secrecy Act, and AML, anti-money laundering rules, laws, and regulations. Okay, they did not comply with a bunch of things, and they got hammered. And the kind of message has been sent out to everyone in the banking industry that, hey, look, your BSA and AML, they better be up to snuff, and you better be keeping an eye on this stuff. Otherwise, we're going to hammer you. We're going to come down on you big time. So, and I think because of that, a lot of banks are going to be very reluctant. They're going to say, this might be a big opportunity, but it could also be a major headache. And do we really want to go down that road? So again, this was just another interesting episode looking at stable coins, considering just different things that banks might be able to do with that. So that was out on Friday. So those were the 5 episodes that I put out for the week. So now let's get into some banking news, shall we? So bank trading revenue increased in the second quarter. So the OCC reported cumulative trading revenue on commercial banks and savings associations of $16.6 billion in the second quarter, up 10.7% from the previous quarter and 2.2% from a year earlier. We also had an update on derivatives exposures. Derivatives still mainly maintaining about the same. The Fed's bar, Governor Michael Barr expresses concerns with proposed stress test updates. So Federal Reserve Governor Michael Barr said it is important to maintain the dynamism and rigor of stress testing at the nation's largest banks so supervisors, banks, and the public understand the underlying vulnerabilities at these institutions. Fair enough. Trump promises tariff refund for farmers. Yes, huge deal. President Trump said on Thursday that the administration plans to use a portion of tariff receipts to assist the agricultural sector. Yes, I think that's great. Fantastic. FHFA withdraws from climate group. So the Federal Housing Finance Agency formalized its withdrawal from the network of central banks and the supervisors for greening the financial system. I think that's fantastic. The FHFA, manages our mortgage system. They really don't have anything to do with climate change. ICBA urges the CFPB to withdraw a proposal to narrow non-bank supervision. So ICBA expressed strong opposition to the Consumer Financial Protection Bureau's proposal to narrow its supervisory designation authority by requiring both a high likelihood and significant harm directly connected to consumer financial products. So the CFPB in August proposed adopting a standard that says it can supervise non-banks if it determines that the non-bank's products or services pose a risk to consumers. The proposal would adopt a standard definition requiring a risk to be significant and a high likelihood before supervision, binding it in proceedings to designate non-bank covered persons for supervision. So again, what it really sounds like there is basically that the CFPB doesn't want to go. They don't want to go on a wild goose chase, right? They want to make sure that if somebody is doing something or messing around, that they can go after them and get them. But it's not. But they're just not needlessly going after people. Is basically what it looks like there. So Fed issues frequently asked questions on end of U.S. penny production. So I did an episode on this a few months back. So the Federal Reserve released frequently asked questions on anticipated changes to penny ordering and deposits following a Treasury Department decision to end production of the U.S. penny coin. So for people who don't know, in 2026, I believe the Federal Reserve the U.S. Mint is going to stop printing pennies. Now, you could still deposit pennies in banks. The bank will still accept your pennies. You can still use pennies when you go to the store. So nothing is going to change in that sense. It's just that they're not going to be making any new pennies going forward. So that will, cause a little bit of different things there. If you want more information on that, go look up the episode I did on that a few months back. So ICBA urges National Flood Insurance Program extension. So the ICBA urged Congress to extend the National Flood Insurance Program authorization before it expires next week. So yes, they do need to desperately extend that. However, as I talked about at the beginning of the program, with the shutdown looming, I doubt that's going to get extended if we go into a shutdown. So we'll have to see what happens with that. ICBA groups request Treasury comment extension on the Genius Act. So ICBA and other groups called on the Treasury Department to extend the 30-day comment period for its advance notice of proposing rulemaking on the implementation of the Guiding and Establishing National Innovation for U.S. Stablecoins, otherwise known as the Genius Act. So just looking for more time on comments there. Cybersecurity coordination law to lapse next week if Congress doesn't act. So the ICBA continues working with Congress to advance an extension of a law that strengthens public-private cybersecurity coordination before the law expires next week. So what is this? So this is the Cybersecurity Information Sharing Act of 2015, which helps ensure community banks have timely access to actionable cyber threat information. Is slated to expire on Tuesday, September 30th, unless Congress passes an extension. What's known as the CISA law provides liability protection for all community banks that share threat intelligence with other banks, businesses, and the U.S. government. While the ISAC is working on a contingency plan, voluntary threat information sharing is expected to decline by 80 to 90% if the law lapses. So again, with the potential shutdown, that would negate any kind of extension, at least in the short run. So, we'll have to see what happens there. But I would tell people, there's a lot of there are other issues with that. While it does some good things, there are other issues with the Cybersecurity Information Sharing Act, which I'm not gonna get all into here because I got a lot more that I want to get with you guys here before the show ends tonight, because we got a lot more to go through. But I just want to note that there are other issues with that act that are of a high concern, and that's why it has gotten stalled, because I think there's a lot of people in Congress that basically said, no, we don't want to dismantle that law, but we need to make a lot of significant changes to it. So I'll just leave it at that. We'll see what happens with that. ICBA raises profile of payments fraud at interagency commission meeting. So ICBA spotlighted payments fraud trends in a presentation to the Financial Education and Literacy Commission, a statutory commission chaired by the Treasury Secretary and comprising the heads of 24 federal agencies. So yeah, they just basically went on there and just told them that, hey, fraud still major, huge issue. So Powell Bowman discussed economic outlook impact on monetary policy. So Federal Reserve officials discussed the economic outlook and striking the right balance in monetary policy during separate remarks this past week. ICBA community bankers meet with banking agencies on core processors. It's kind of interesting. So 10 ICBA community bankers and several staff members met with federal regulators to discuss community bank experiences and concerns with core service providers. Now, who are the core service providers? Well, you have the big three are Fiserv, Jack Henry, and FIS. Those are they probably have 70%, 70 some percent of the market. They are the core system provider for thousands of banks across the country. So basically, with the federal banking agencies working to understand community bank issues with core processors, the ICBA representatives met with the Federal Finance Institutions Examination Council's task force on supervision and community bank and credit union digitalization subcommittee. So interesting. Credit union acquisitions of community banks continue garnering media attention. Yes, I just did an episode on this. What was the episode? Hang on a second. What was the episode I just did on this about a week ago? Yeah, I did basically credit union purchases of community banks are in fact harmful. So just an episode you guys might want to go. That was about 2 weeks ago. You might want to go check that episode out. So, but anyway, credit union acquisitions of community banks received renewed media attention this week with a new article on the largest acquisition so far this year. The article from Typhone notes a deal announced in July would be one of the largest credit union acquisitions of a bank in U.S. history. The article cites a statement from ICBA President and CEO Rebecca Romero-Rainey, noting that nearly 2/3 of credit union acquisitions involve a bank with a positive net operating income in the preceding 5 years. Yes, and that's kind of what I covered in that episode that I did on credit unions. Feds prepare for September 30th transition from paper checks. Now, this is important. The federal government launched an updated webpage with information on its September 30th transition away from issuing paper checks for most federal payments, while the IRS said it will publish guidance before the 2026 filing season begins. So again, the federal government is going to begin to move away from using paper checks. So Social Security recipients, you're not going to get a physical check in the mail anymore. You're going to have to set it up. You're going to get like a direct deposit into your bank account, that kind of thing. Same thing with federal employees and vendors and everything else. So again, that is a big, big change that people need to be aware of. Treasury and IRS issue no tax on tips proposal. So the Treasury Department and IRS issued proposed regulations identifying the occupations that customarily and regularly receive tips before 2025 and thereafter may be eligible for the no tax on tips deduction of the One Big Beautiful Bill Act. So the proposed rule includes sections on various eligible occupations, including in the beverage and food service, entertainment, home services, and transportation. So go, check that out. If you want to find out if your job qualifies for no tax on tips, go just Google that proposal from the Treasury and the IRS. Like I said, yeah, we already talked about that. Treasury, so we've already talked about that. ICBA urges FDIC to reject the risky ILC applications. So the ICBA told the FDIC that it has a statutory duty to reject the applications of industry loan companies that pose undue risks to the Deposit Insurance Fund and fail to serve the convenience and needs of their community. So, So again, we've seen a lot of companies trying to use what's called the ILC loophole to get banking charters. Not a good thing. I've done several episodes on that. If you want to learn about the ILC or the ILC loophole or bank charters, go back. You can go to YouTube, you can go to Rumble, you can look up, go through my past episodes, but you definitely can find that on there under a simple search. ICBA urging comments to FDIC on raising the regulatory thresholds. ICBA is calling on community bankers to submit comments this week on the FDIC's proposal to adjust and index certain regulatory thresholds, most notably Part 363 independent audit and reporting requirements. The FDIC's goal for the proposal is to address the unintended outcome where an institution becomes subject to additional or more stringent regulatory requirements due solely to inflation rather than actual changes in the institution's size, risk profile, or level of complexity. Because the FDIC has not made regular adjustments to the Part 363 asset thresholds mandated under the Federal Deposit Insurance Corporation Improvement Act of 1991 to keep pace with industry changes, the current limits no longer provide a meaningful exemption to community banks. So, and let's see here. Do I have any other news that I think would be big stuff here? Let me just check this one thing real quick. No, I don't see. Nope. See anything else? I keep in mind, we still got a lot to go through here tonight. So let's get back to the articles here. All right. Let's talk about the farce that is the HB1 visas here. So a couple articles here related to this. So Trump's $100,000 H-1B fee sparks a global race to grab top talent. So the Trump administration's revamp of the H-1B visa program is widely regarded as an opportunity for other major economies. The UK, Europe, Middle East, and Asia are thought to be among those that stand to benefit in the race to recruit top global talent. U.S. companies, however, have also sought to seize the initiative. Then we go to this. We need the smartest people. I love this claim. This is my favorite claim. We need the smartest people. NVIDIA, OpenAI CEOs react to Trump's H-1B visa ban. So NVIDIA CEO Jensen Huang says he's glad the administration is making moves around immigration, but says immigration is key for the U.S. getting the brightest minds. OpenAI CEO Sam Altman says outlining financial incentives seems good to me. The comments come after the Trump administration announced it would raise the fee for an H-1B visa to $100,000, which left companies scrambling over the weekend. Now, I want everybody to understand the H-1B visa thing is got to be one of the biggest scams out there. And it is not about getting the best and brightest. And look, I would say this. If one of these companies finds the next Albert Einstein, okay, believe me, exceptions will and can and will be made. They will bring these individuals in. You find the guy who's going to provide the next law of thermodynamics. Okay, I guarantee you we will make an exception for that individual. We will bring them in. That is not what the H-1B visa is. This is a way for all, and not just, this is not one of these tech companies. This is all of these tech companies. This is all of Silicon Valley. They basically fire and lay off their U.S. workers, and then they bring in the cheap labor on the H-1B visa. It is a scam. It's been a scam for decades now, and in my opinion, it needs to stop. It needs to come to an end. But let's keep going here for a second. So Trump's H-1B visa changes could kneecap startups, drive talent elsewhere, experts say. Really? Why is that? Experts say Donald Trump's changes to the H-1B program could deter startups from securing top foreign talent and drive those workers elsewhere. Really? Trump sparked widespread panic Friday after announcing employers will pay a new $100,000 fee for H-1B visas, which are temporary work visas granted to highly skilled foreign professionals. We need American little tech to win, not 100K toll booths, said Gary Tan, CEO of Y Combinator, the popular startup accelerator. No, again, they're just worried that startups won't have access to cheap labor. Okay, that's the big gripe, not talent. Okay, there's a huge difference here between talent and cheap labor. Okay, they say that they're concerned with talent, but they're really concerned with cheap labor. That's really what they're getting at here. Oh, okay. So I went ahead here to TikTok. Okay, we'll get to TikTok here in a second. So, but again, I just want to say here, I think that to me, my opinion, again, for whatever my 2 cents are worth, the $100,000 fee, which initially was announced as an annual fee, but it's not an annual fee. It's just a one-time fee of $100,000 to get this H-1B visa on top of whatever it is you're paying that individual. I think that is, to me, that is a good start. It doesn't go anywhere near far enough. And I just asked the question, like, why play these Mickey Mouse games? Why not just end the H-1B visa? Why not just end it right now? Get rid of it, get rid of all those people and just tell these companies, hey guys, sorry, you're just going to have to hire Americans. You're just going to have to hire Americans to come work these jobs. And that's how it's going to be. That's where I'm at it. Some people may not like that, whatever, so be it, but that's how I feel about it. So anyway, so we will keep an eye on this as we do so many other things here on the channel. And I'll bring everybody updates as they unfold here with the H-1B visas. All right, let's talk about TikTok for a second. Some very interesting articles here. So now last week, I reported to everybody that basically that they were very close to cutting a deal on TikTok. And I showed everybody a couple articles, everybody's kind of agreed on principle. We had some big updates here in the last couple of days. Basically, Trump signed an executive order on Thursday, approved a deal on Friday. But I wanted to show everybody a couple of articles because they had a little bit of a stall kind of at the end of last week, and they stalled for exactly the reason why I thought they were, even though I may or may not have said it in the strategy room episode last week. But my initial thought was that they were arguing over the algorithm. That was the big argument, that, basically the American negotiators were saying, listen, you're going to sell, ByteDance can still maintain a little ownership. You're going to sell the bulk of the ownership to American individuals, American companies, and they are going to take control of the algorithm, which is the most important thing. That, and China's basically sitting there. I'm sure they were sitting there going, no. We will sell you the company, but we are still going to make control over that algorithm. And I think the U.S. was going, no. That's not going to happen. As Trump would say, that's not going to happen. We are going to control the algorithm. That's how it's going to be, because we're going to make a big algorithm. It's going to be bigger, more beautiful, more wonderful. That's my bad Trump impersonation. All right. Anyway, so Trump approves TikTok deal through executive order. Vance says business is valued at $14 billion. So Donald Trump on Thursday signed an executive order approving a proposed deal that would keep TikTok alive in the U.S. Under the deal's terms, which China must still approve, a new joint venture company will oversee TikTok's U.S. business, while ByteDance holds less than 20% of the stock. Vice President J.D. Vance said the transaction values the business at $14 billion, but no purchase price was provided. And then let's see here. So Trump signs deal to put TikTok under U.S. ownership. Vice President J.D. Vance says Americans could have confidence that the popular video platform would not be used as a propaganda weapon. So President Donald Trump approved the TikTok U.S. deal on September 25th, signing an executive order that will give China-based ByteDance 120 days to finalize terms with American investors. The United States in 2024 enacted a law that required ByteDance, a foreign adversary-controlled company, to divest itself of the popular social media app. Pursuant to the law, ByteDance will be limited to holding a stake of less than 20% in the new joint venture. We have American investors taking it over, running it, Trump said in a news briefing on September 25th. We have very good controls. So, okay, fair enough. Let's take that at face value for the moment, right? So, and here's what I wanted to get to, these next two articles here. And I just want to make sure I have my dates right here. So that's the 22nd. And this came in on the 20th. Okay, so let's start with this first. So, because this was on September 20th. So U.S. companies to control TikTok algorithm with data, White House says. So Congress passed a bipartisan bill in 2024 requiring the social media app's Chinese parent, ByteDance, to divest from the app or face a ban. So a deal to bring TikTok's U.S. operations under American ownership has been finalized. It should be signed soon. But Levitt made remarks as of 2020 on Fox the day after. Let's see here. The Chinese regime's Public readout offered a more cautious tone, saying only that companies were free to conduct commercial negotiations based on market rules. TikTok's fate has become a vexing issue. But let's see here. We were the algorithm will also be controlled by America, she added. The algorithm that powers TikTok's content recommendations has long been considered the most contentious part of the negotiations. Chinese regulators updated export control laws in recent years to cover such technologies, giving Beijing leverage over any divestiture. U.S. negotiators have insisted the algorithm must be under American control. Treasury Secretary Scott Bessent told reporters after talks in Madrid that Chinese officials are interested in Chinese characteristics of the app, which they think are soft power. We don't care about Chinese characteristics. We care about national security. So yes, and then let's go back to this other article here. So Oracle to retain TikTok algorithm under new U.S. ownership. Trump will give the investors and ByteDance 120 days to finance the deal. So the U.S. cloud company Oracle will oversee the code and security of TikTok, a senior White House official said on September 22nd. President Donald Trump has said, yeah, we talked about that. A law went into effect. Yeah. The American board members, let's see here. Okay, so the American board members will have backgrounds in cybersecurity and national security to bring the necessary oversight and know-how to ensure that the joint venture is both successful and safe and secure for Americans, the White House official said. Unlike with other major tech deals Trump has assisted with recently, such as with Intel, the U.S. government will not be taking a share in the new joint venture. ByteDance is expected to sign a framework agreement with one of the new managing investors following Trump's expected executive order within the 120-day period. So Oracle's role. So the official said that acquiring the algorithm for the popular social media app was a tough point of negotiation and required some compromise to meet both U.S. and Chinese legal requirements. Chinese export laws on recommendation algorithms were what previously prevented the sale of TikTok to U.S. investors. Trump announced after a 2-hour call with Xi on September 19th that the two leaders had made progress on a deal. He then told reporters, we look forward to closing the deal. So the official said Oracle will be responsible for overseeing the security of the app, which includes how it interacts with users' phones and how user data are handled. Oracle currently stores TikTok data for U.S. users on servers in the United States and will continue to do so. So again, the algorithm is going to be retained and it's going to be controlled by Oracle. So that will be a very interesting thing here with the TikTok deal. Very interesting indeed. We'll have to see how this plays out. But no doubt, this was the biggest point of contention with this deal. There's absolutely zero doubt about that. Just because, China wanted to maintain control over the TikTok algorithm. I don't think selling the company was that big a deal. They definitely, absolutely wanted to maintain control over that algorithm. So again, we'll see what happens here with TikTok, or some might call it TikTok. Okay, let's get to a little tariff manufacturing trade news here. So U.S. manufacturing continues to expand as business confidence rises and price pressures ease. So factory growth has cooled somewhat from summer highs, but remains solid as inflation eases and inventories rise. So U.S. manufacturing activity expanded in September for a fourth straight month, even as growth slowed from recent highs, with business confidence improving and price pressures cooling, according to S&P Global report. S&P Global's Flash Purchasing Manufacturers Index, released on September 23rd, showed that the manufacturing activity index came in at 52 in September, down slightly from 53 in August, signaling continued growth in factory conditions. Readings above 50 indicate expansion. The broader U.S. Composite Output Index, which includes services activity, eased from 53.6 to 54.6. Marking a 3-month low, but still pointing to expansion. So again, this is really good. So we're seeing manufacturing starting to pick up a little bit of steam here, starting to roll, which is fantastic. That's what we like to see. Now, what about the trade deficit? So the U.S. trade deficit shrinks nearly 17% in August. So imports retreated sharply, pushing the goods deficit to 85.5 billion and bolstering the case that tariffs are reweighing trade toward U.S. producers. So the U.S. trade deficit in goods shrank nearly 17% in August, one of the sharpest improvements in the past year. New Commerce Department data shows the goods gap narrowed by 16.8% to 85.5 billion, down from 102.8 billion in July. The Commerce Department's Census Bureau reported on September 25th. Economists surveyed by Reuters had forecasted the deficit narrowing to 95.2 billion. The Trump administration has made reducing trade deficits a hallmark of its economic strategy, coupled with policies to revive U.S. manufacturing. The sharp August swing follows a July slump in imports, which widened the goods gap by more than 20%. So again, great news here. We saw a 17% shrinkage of the U.S. trade deficit in August. That combined with the pickup in manufacturing is a very good thing. Hopefully those trends will continue. As I mentioned a little earlier, the U.S. will use tariff revenues to help farmers, according to Trump. So the first Trump administration provided a similar aid program to farmers after exports plummeted during the previous trade war with Beijing. So President Donald Trump said on September 25th he would use tariff revenue to provide aid to American farmers until his import levies start to benefit them, which he said is only a matter of time. We're going to take some of that tariff money that we made. We're going to give it to our farmers who are, for a little while, going to be hurt until the tariffs kick in to their benefit. Trump said from the White House on September 25th, we're going to make sure that our farmers are in great shape because we're taking in a lot of money. Ultimately, the farmers are going to be making a fortune, but it's a process. It has to kick in. So again, we'll keep an eye on that, but that is great news. Here's another one. Energy Department to return $13 billion in unused climate funds to taxpayers. I love it. How often, think about it, how often do we see the federal government or some, government agency actually giving money back that wasn't used to the taxpayers, right? So I love it. They're going to return $13 billion. The department says unobligated money will be sent back to Treasury, fulfilling pledge to halt reckless spending on climate programs. Fantastic. The Energy Department has announced it will return more than $13 billion in unobligated climate funds to the Treasury, marking one of the Trump administration's most significant reversals of President Joe Biden's green energy agenda. The department said on September 24th that the money had been set aside under the 2022 Inflation Reduction Act enacted by the Biden administration. Energy Secretary Chris Wright said the step fulfills President Donald Trump's pledge to redirect resources to the department's core mission. So, and again, I think this is just a taste, man. I think this is just a taste. We could see a whole lot of money coming back. I want to say I think there might be hundreds of billions of dollars, maybe even $1 trillion of money sitting out there in, what are there, 430 something government agencies out there? I mean, so how about we, again, and that's why I loved Doge. I loved what Doge was doing. It's like, let's comb through all these agencies. Let's find all these billions of dollars that are not being used, are just sitting there, and let's bring that back. But here's the thing. Let's take that money and wait for it. Let's start paying down the national debt with that money. Let's recoup that money. I mean, think about it. If you could find a couple $100 billion, if you could find $100, $200, $300, $400, $500 billion, and you could take that, let's pay that back to the national debt, man. If it's not being used, let's put it back to good use. Okay, let's get back into some banking news here for a few minutes. So I had a couple of interesting stories here. So Ocean First is basically set to lay off 10% of their bank's workforce, due to their residential mortgage department. So they're going to be, Ocean First Financial Corp will lay off 114 employees. Ocean First partners with Embrace Home Loans for residential financing. The bank has shifted focus to commercial banking growth. So Ocean First plans to lay off more than 10% of its workforce as part of the bank's plan to farm out its residential loan origination business. Yes, so very interesting news there. And I would tell you one of the reasons why I wanted to point this article out is because it is notorious for banks to kind of manage the residential mortgage business. The residential mortgage business is either really great or it's really bad. It's never really in the middle. And as a result of that, it can be very difficult to balance. Like you hire a lot of people, you bring those people on, and then the mortgage market kind of sours or it really slows down, and now all of a sudden you've got a whole bunch of people just sitting around, not really doing much of anything. So I just wanted to point this out, not necessarily to pick on Ocean First, but just to say that like this is something. It's an issue. It's an issue. It's always been an issue in the banking business, and it's something that I will probably talk about at some point in an episode as I lay out a little bit more in there. So, okay, now in my area in Pennsylvania, we have not had a ton of M&A activity. And then all of a sudden this week, the dam kind of broke. And we all of a sudden, for the first time in a while, we had a couple of deals. Now, this one hit very close to home. This one impacted me on a personal basis. So QNB Bank is expanding their footprint by purchasing Victory Bank. Now, Victory Bank was a startup bank that started in 2008, and it was a startup that I was heavily involved in with. I was the first lender. I was employee number 12 of Victory Bank. Victory Bank literally was a full-blown startup de novo bank. I have not worked there in a long time, but still remain friends with many people, know a lot of people that work over there at that bank. And I just, it definitely took a little bit out of me this week because I was very bummed out to hear that. Love those guys over there, wish them nothing but the best. And, QNB is a great bank in the PA area, PA market. They've been around a long time. I think the combined organizations here are going to be probably about a $2.5, $2.6 billion bank. So it'll be a very good organization here putting these two together. But yeah, this was one that just it hit very, very close to home on this one this week. But then we had another transaction. We had Mid-Penn Bank Corp to acquire First Colonial Bank for $101 million. Now, First Colonial was primarily a New Jersey bank. So Mid-Penn Bank was a bank over in the PA market, wants to expand over into New Jersey. So again, another big kind of deal for a PA bank in the local kind of southeastern PA, southeastern PA and New Jersey markets. So just wanted to point those two deals. I predict probably a few more deals to come in the PA market, to be sure. And then, okay. The FTC drops their non-compete ban, but some employers are getting a warning. So I had been following the whole non-compete issue that was going on with the FTC. That's been going on for, I think, a little over a year, maybe about 2 years now. But basically, the FTC abandons the broad non-compete ban, focuses on individual enforcement. So FTC they do urge healthcare employers to review employment agreements. States introduce legislation to restrict or ban non-compete agreements. So the Federal Trade Commission has officially abandoned the Biden-era efforts to broadly ban non-competes, but that doesn't mean the agreements will escape enforcement efforts. On September 5th, the FTC voted to essentially end its current appeal of a previous court order that barred a rule to ban non-competes from going into effect. The FTC's rule, finalized last year, was met with multiple court challenges, and it was widely expected that the FTC under President Trump would end those efforts. Current FTC Chair Andrew Ferguson has called the rule unlawful. Legal experts had largely agreed and said it faced an uphill climb in the courts. But even with the decision to drop the appeal, that doesn't mean the agreements will escape enforcement scrutiny, meaning employers should encourage any non-compete agreements mesh with existing laws and regulations. Additionally, many states have their own laws targeting non-competes that employers need to be aware of. Now, again, and where I have landed on this issue is that I thought it was utterly ridiculous for the FTC to go down this road. This was classic government overreach on the part of the Biden administration. Non-competes have been around for a very long time. They exist for very real reasons. They're not there for for laughs and giggles. They're there for very big reasons, because a lot of companies out there have to protect intellectual property. They have to protect the assets of the business. And sometimes the only way they could do that is with non-competes. Now, is it also true that non-competes can sometimes be unfair or overburdensome to an individual or prevent an individual from working for a certain period of time? Yes, they can. But unfortunately, we don't live in a fair world. It's not fair. And you know what? You knew that the non-compete was there when you took the job. When you agreed to take the job, you signed the document saying, yeah, I know that there's a non-compete here, and I know what the non-compete says, and I know that if I leave or if I get terminated or whatever, this non-compete is in effect for X amount of time. The other thing is that the non-competes do not stop somebody from working in an industry forever. It's usually just a period of time, maybe 6 months or a year or 2 years at the most. So again, I did not like this whole thing from the beginning. Now, it is also fair to say that some states have basically said that, hey, they're just gonna pass their own non-compete ban, which is fine. That's their prerogative if they want to do so. I don't think that's right, but okay, so be it. But like I said, I just wanted to bring everybody an update on this one, just let them know what was going on. So, all right, what else do I got here? Let's cover a few more things here. I only got a few minutes left, whereas it'll be time to wrap this one up tonight. So, OCC bans 5 from TD Bank, Wells, and PNC. So 5 former bank employees have been penalized in cases that involved alleged PPP fraud, misappropriation, and theft. So the Office of the Controller of the Currency has banned 2 former TD Bank employees, 2 former Wells Fargo employees, and 1 former PNC employee from the banking sector indefinitely. The agency announced on Thursday. Armando De Leon, who managed a TD branch in, and I'm not going to say this right, Wailea, Florida, from 2007 to 2021, allegedly submitted fraudulent COVID-era Paycheck Protection Program loan applications for 2 limited liability companies he formed and owned. That's nice. By falsely claiming he had 4 employees and produced illegitimate Internal Revenue Service forms, De Leon enriched himself with over $80,000, the OCC alleges. Sharon Meadows, who managed a team at TD's Mount Laurel, New Jersey call center from 2017 to 2024, allegedly misappropriated at least $150,000 from the bank in the final 3 months working there, the OCC said. Meadows allegedly did this by repeatedly causing TD to credit his personal account at the bank and withdrawing the funds. Carolyn Hicks, who worked at a Wells Fargo branch in Columbus, Georgia from 2003 to 2024, most recently as a bank operations assistant manager, allegedly misappropriated roughly $25,000 from a bank ATM between January and February 2024. Walter Riano Venegas, who worked as a teller at a Wells Fargo branch in Linden, New Jersey from 2018 to 2022, stole $15,670 from 2 branch ATMs. And then Gerard Milligan, who worked as a teller at a PNC branch in Royal Palm, Florida in 2020 and 2021, allegedly made false attestations on a PPP loan application for his business, the OCC said. So interesting stuff there. Tennessee Bank aims to raise up to $103 million in IPO. So Commercial Bank Corp Groups wants to list on the NASDAQ. It's putting more than 3.7 million shares on the public market. It is expected to fetch up to $27.75 per share. So there you go there. So Commercial Bank Corp, a Tennessee-based state-chartered commercial bank, aims to raise $103.7 million through an initial public offering. The company said in a press release Monday, stricter regulations, higher compliance costs, and volatile market conditions have made public listings increasingly rare for banks since the 2007-08 financial crisis. The bank expects to list on the NASDAQ under the ticker CBK. So interesting. So we'll see how that goes. FIS acquires fintech called Amount. It's kind of funny. It kind of says that FIS acquires fintech Amount. The Chicago-based fintech, which provides banking technology, expands the portfolio of services FIS can offer banks and credit unions. So payment processor Fidelity National Information Services has acquired Amount, a fintech that provides deposit and loan origination software, according to a Wednesday news release. Chicago-based Amount provides consumer and small business deposit and loan origination software. FIS said Amount will expand the services it can offer bank and credit union clients and aligns with its strategy to add cloud native and modular products and services. Terms of the deals weren't disclosed, and an FIS spokesperson declined to comment. Amount has 158 employees, all of which have joined FIS, the spokesperson said. FIS will maintain the fintech's Chicago location. So interesting there. And then let's see here. Last article I have for the night. So day trading is about to get easier for smaller retail investors. So the Financial Industry Regulatory Authority has approved amendments that would replace the long-standing $25,000 minimum equity rule for pattern day trading. The change is pending approval by the Securities and Exchange Commission. So regulators are moving to dismantle one of the most controversial barriers for active retail traders, the $25,000 minimum equity rule for pattern day trading. The Financial Industry Regulatory Authority on Tuesday approved amendments that would replace the long-standing threshold, making active day trading more accessible to smaller accounts. The change is pending approval by the Securities and Exchange Commission. The $25,000 minimum equity rule mandates the traders must maintain a minimum account balance of $25,000 in a margin account to execute 4 or more day trades within a 5 business day period. The rule was put in place in 2001 amid the dot-com bubble and crash as regulators grew worried that small traders were taking excessive risks with volatile internet stocks. FINRA is replacing this mandate with an intraday margin rule that applies the existing maintenance margin rules to intraday exposure. In other words, one's intraday buying power will be based on the margin requirements for the positions they take on during the day, not a fixed equity minimum. The regulators said the overhaul reflects how technology and market access have transformed retail trading since the rules were first adopted. The rule change could lead to more options trading and boost activity for brokers like Robinhood. Robinhood shares rebounded from earlier loss and were higher by 1% in Wednesday trading following the FINRA news. So there you go. So maybe some potential good news for day traders here. So we will have to see on that one. All right. So with that being said, everyone, let's wrap up tonight. So I got a couple things here before I get to my story of the week and my quote of the week, as I always end episodes with. But before we do that, I want to get to my items here at the end. So if you're listening on Apple Podcasts and Spotify, I need reviews. Please leave some reviews. I would love to hear back from people if they're enjoying the podcast, if they're enjoying the show. Please leave me some reviews on Apple Podcasts and Spotify. Please make sure to go and check out the bankernextdoor.com. That is, I've been doing a lot of work on the website there. And I hope that people will go check that out, thebankernextdoor.com. Subscribe on YouTube if you want the latest updates via posts. I always post out, like, for example, every Sunday night, I usually post out the titles of all the episodes that are coming out the week, Monday through Friday. If for some reason I have a change in the strategy room, like if for some reason, like occasionally I have to go to Friday night instead of Saturday, if I am doing that, I put those posts up on YouTube ahead of time so that people will know that I either moved the time of the show or something happened, what have you. If you have any questions or if you would like to recommend a topic that you would like me to cover, you could send that to info@thebankernextdoor.com. So remember, that is info@thebankernextdoor.com. If you'd like to email me, like I said, any comments, any questions, topic recommendations, you can send it to that email address. Make sure to follow me on Getter X and Truth Social. I am up on these different platforms. Might be up on some other platforms shortly. I'll keep you posted on that one. Remember, BND is on YouTube, Rumble, and all major podcast platforms. We do new episodes every week, Monday through Friday, premiering at noon. Most episodes are usually about 10 to 20 minutes in length. I try to keep it to small, very manageable, consumable chunks, if you will. And then do not forget the BND Strategy Room live stream is every Saturday night here on YouTube at 8 o'clock. I am hoping to expand this to Rumble, X, and Getter in the coming weeks. working on all that right now behind the scenes. So hopefully I will be doing this live stream will be hopefully spread out onto more platforms coming soon. And then just keep an eye out. I am going to be doing some special reports. I'm going to be doing some special live streams over the next 4 or 5 weeks. I have some topics that I've been building. Like usually I've been doing these kind of AI updates. I've got the crypto series that I've been doing. Well, I've got so much news and information on these particular items that I can't cover it in like a 10 or 20-minute episode. So I'm thinking I'm going to do probably like 1 hour, maybe hour and a half. The AI one will definitely be probably like an hour and a half live stream. But the crypto might just be like 40 or 45 minutes. But I'm also doing healthcare. I'm doing a very interesting update on healthcare. I'm going to do an episode on China. I have some very interesting China news I think people will find interesting. I'm going to do a personal finance one that I think people will find some great information on that. And then I'm also just going to do maybe 1 or 2 with just extra news. I have so much news that I just don't get a chance to get to every week, but still very important things that I'd like to share with everybody. And that kind of extra news has been building for a while. So I might do a couple extra live streams just to kind of get that stuff out there to people. So like I said, keep an eye out. Again, if you're subscribed on YouTube, you'll see that information in the post. I'll certainly let everybody know on the weekly Strategy Room live stream when that stuff does come up. So keep an eye out, like I said, for those special reports coming over the next few weeks. I'll be putting that up. If you subscribe on YouTube, you'll see that. You'll get notices of that. And I will certainly, if you follow on Apple Podcasts or Spotify, I will certainly post, those episodes up after we're live, after we go live. So, okay. All right. So that being said, let's get to our story of the week and our quote of the week here. So, okay. I saw this yesterday, and I had to go with this one. So September 26th, 2001, Enron CEO Kenneth Lay led an online employee chat in which he urged the company's workers to talk up the stock. He declared, "My personal belief is that Enron stock is an incredible bargain at current prices, and we will look back a couple of years from now and see the great opportunity that we currently have." It soon filed for the largest ever U.S. bankruptcy, and that was the failure of Enron. If you have never seen Enron, The Smartest Guys in the Room, the documentary about Enron and the failure, definitely want to go watch that. I might try to do something with that. I might try to do some kind of a watch along if I don't get hit with some kind of a content strike or something like that, which I probably would. But I would love to do something like a watch along where, we watch that documentary for 2 hours and I kind of comment on things as we go through and, maybe take questions from people, that kind of thing. I think that could be a lot of fun. But like I said, we'll see that. But like I said, I saw this just the anniversary of the failure of Enron. Next year will be 25 years from that failure, which I'm sure you will see a lot of articles and news. You might even see some new books on the failure of Enron, like a retrospective, it would be the 25th year anniversary. So I'm sure you'll be seeing that stuff coming this time next year, probably August, September, October. I'm sure you'll be seeing a lot of that stuff on there. And Enron, The Smartest Guys in the Room, will probably start to see more play on that documentary as those dates come back around. So, okay. That being said, okay, what is our quote of the week here? So, okay, everybody ready? Nothing has such power to broaden the mind as the ability to investigate systematically and truly all that comes under your observation in life. And that is from Marcus Aurelius in his all-time epic work, Meditations. So again, nothing has such power to broaden the mind as the ability to investigate systematically and truly all that comes under your observation in life. So in other words, do your homework, do your research, think for yourself, form your own opinions. Okay, do not just regurgitate what is said on the mainstream news media. Do some investigation in life. Look at stuff, read some books, read some news articles, maybe ask a question or two. Always good things to practice in life, right? Well, okay. with that being said, I would just ask everybody, hey, if you like what you're seeing, please make sure to like, share, and subscribe, as that really helps the channel, really helps the podcast. Again, new episodes coming Monday through Friday. I hope everybody will come back and join me again next Saturday night here in the Strategy Room. I hope everybody had a good time hanging out tonight. I know I certainly did, as I always do every week. But I hope everyone has a great weekend out there. I thank everyone for listening. Be safe. Take care, and I will see everyone again, same time, same bat channel next week. Have a great one out there, everybody.